When you look at Italy, so I think there's my chart somewhere. I have it here on my screen. You'll be able to see it shortly. And it's basically the fact that the rating outlook being cut by Fitch is worrying investors. And you can see the Italian-Spanish 10-year spread actually rising quite significantly. What's the worst-case scenario here?
Well, worst-case scenario is the standoff with the European Union starts to spread into a signal from the Commission to the European Central Bank to start to consider the role of bond buying in Italian bonds. Now, I think we're a long way from there. I think there's an important further bit of information we need to get out of the Italian government. What kind of spending, what kind of profile are we looking at? Because let's remember that these standoffs between the budget rules between European Union members and the Commission are quite regular, and a lot of it comes down to how good nation states are at making the case for this is the kind of spending that takes us on a more stable platform against the backdrop of some infrastructure spending where the payoffs are quite good. That is a more credible way to go and argue your case rather than something that feels like pork barrel spending, which is likely to be rejected by the Commission and would lead to that spread only widening.
But do you worry about the catch-22 about how much banks have exposure to Italian bonds and actually the fact that the economy is vulnerable also because of that? Yeah,
well, I do worry. You look at the progress the Italian state has made on the banking sector has made on non-performing loans, which are about 2 to 3 years into that recovery. That's based on a growth pickup in Italy. We mustn't lose sight of that, and therefore what we do need to understand is if an expanded fiscal trajectory from the Italian government passes through to higher growth, and let's not dismiss that as an outlook, then of course the industrial performance of the Italian economy, which will of course drive non-performing loans, will improve. This is why the details of any fiscal plans are really, really important.
Simon, if you go back to my chart and actually have a look at my chart, is this again the markets actually because of the rhetoric, especially that we hear from Matteo Salvini saying Italians first at every corner about everything, is this making them concerned that actually he doesn't care about the rules, that he may at some point want to also try and take Italy out of the euro? Yeah. Or is this, the spread justified?
Well, that spread is justified because what you worry from Salvini's rhetoric is that he won't take the high road in terms of setting out a budget plan, going into negotiations saying, look, this is prudent economic management. Yes, it breaches the budget rules in the short term, but actually we're putting Italy, which, let's be honest, has not grown for the best part of 20 years on a net basis, we're putting it on a more sustainable footing. If he's going to start attacking rating agencies, the Commission, then that will worry investors because you go, well, you dismiss the idea that this is prudent economics and you start to see this as a rhetorical battle, and that always ends badly for the weaker partner. Unfortunately, in this scenario, the Italians versus the Commission or the European Central Bank are going to come second.
What does it mean for euro?
Well, I think in the short term, you have to start to look at whether the ECB start to bring this into discussions over their policy outlook for 2019. Because I think most people are, OK, they understand the policy path through to the summer of 2019, but they really don't know the path beyond that. When's the first hike coming? Will the sort of tapering start to move to a sort of balance sheet reduction? We just don't know. There's a deliberate reason for that, of course, which is, of course, Mario Draghi ends in October 2019. And therefore, the path for the euro is very much linked to his successor. But if his successor starts to need to factor in a disruptive Italian slowdown, then of course you get a much softer outlook for growth, which should start to weaken the euro from the levels we currently see.